According to Russia's RIA state news agency, the West stands to lose at least $288 billion in frozen Russian assets if they are confiscated. Could it be that the current sanctions imposed by the European Union and the United States were a mistake? This aggressive campaign against Russia seems to have backfired, as Russia has retaliated with additional sanctions and has started seizing all Western-owned enterprises and assets within its borders, particularly those of US and EU banks. On December 28th, Russia's foreign ministry issued a reaction to the latest round of sanctions, listing various measures of retaliation against the United States and the European Union. What will be the outcome of these sanctions, and how will the West respond? This situation escalated on December 16, 2024, when the European Union imposed additional sanctions on Russia. This new round of economic sanctions is the 15th since 2022, aimed at further isolating Russia economically and diplomatically. However, Putin's administration has responded with countermeasures, potentially targeting more than $280 billion in Western assets within Russia's borders. We are witnessing a new chapter of geopolitical tensions between the United States, the European Union, and Russia. How will this impact both sides? Interestingly, the West has a significant edge in terms of frozen Russian assets compared to the assets Russia could claim from Western corporations. Recent estimates suggest that the West has frozen around $300 billion in Russian central bank reserves and other assets globally. These funds are spread across various financial institutions in Europe and the United States. European banks hold approximately $27 billion, American institutions $67 billion, British banks $37 billion, Japanese financial institutions $36 billion, and smaller amounts in Canadian and Australian dollars. These funds are often invested in foreign stocks, bank accounts, or transactions, making them easier for Western governments to track and seize. Beyond governmental reserves, Russian oligarchs have also faced scrutiny. Their yachts, luxurious mansions, and private aircraft have been confiscated. For example, Germany seized Alisher Usmanov's $750 million yacht and $90 million in real estate. Jersey officials froze $7 billion of Roman Abramovich's assets, while Italy seized Nikita Mazepin's Sardinian property worth over $14 million. Other European nations like France and Spain have confiscated homes and yachts belonging to Russian elites, totaling around $58 billion. The West has leveraged strict sanctions and legal frameworks to freeze these assets. Working through a task, force named Repo, Russian elites, proxies, and oligarchs to trace and seize wealth across borders. Banks have played a crucial role in identifying and holding Russian funds. Comparatively, the West holds the advantage. $300 billion in frozen Russian central bank assets, combined with $58 billion in confiscated oligarch assets, exceeds what Russia can seize. However, in July 2024, Russia introduced regulations to legitimize the process of seizing Western assets. Russia faces challenges, as Western assets worth $288 billion are more dispersed across industries and firms, making coordinated confiscation more difficult. While seizing these assets would be challenging, it is not impossible, which is why the West takes the threat seriously. In response to Western sanctions, Russia has taken a hardline approach, targeting specific areas to exert maximum pressure. The Kremlin's actions aim to counterbalance the economic blows dealt by the sanctions. The unfolding geopolitical conflict raises questions about the long-term consequences for both sides. The challenging environment for Western corporations operating within Russia's borders is evident. Companies wishing to exit the Russian market must sell their assets at a 50% discount, leading to significant financial losses. Additionally, the tax on asset transactions increased from 15% to 35% in October 2024. This exit tax is designed to impose heavy financial burdens on international enterprises while providing financial benefits to the Russian government. Beyond this, strict controls on transferring revenues out of Russia make it difficult for Western corporations to repatriate earnings. By restricting tax repatriation, Russia ensures that money stays within its economy, stabilizing it during tough times but complicating operations for foreign businesses. Diplomatic tensions are also rising, as measures targeting individuals like EU diplomats hinder their ability to negotiate agreements with Russia, potentially causing broader consequences. Major brands like Carlsberg and Danone are already struggling. Carlsberg, a key player in Russia's beer industry, faces heightened scrutiny and is being forced to sell assets at steep discounts, incurring significant losses. Danone, which has heavily invested in Russia's dairy sector, also suffers, especially with restrictions on revenue transfers. In December 2024, a former Russian company owner took over all Danone's operations in Russia, completing the local acquisition. This issue extends beyond Carlsberg and Danone. For example, PepsiCo, which has operated in Russia since the 1970s, now faces challenges such as revenue transfer limitations and forced asset sales. Similarly, ExxonMobil, after investing billions in Russia's oil and gas sector, was compelled to leave without withdrawing any assets. Ford, once a major player in Russia's automobile industry, faces asset seizures and forced sales. The impact on these companies isn't limited to finances. The changing geopolitical landscape is altering how they operate. For instance, Unilever, known for its diverse product range, sold its Russian facilities at a loss in October 2024, making it nearly impossible to repatriate revenues. Siemens, a leading technology supplier, faces the potential confiscation of its infrastructure investments and plans to sell its assets before sanctions tighten further. Russia's retaliatory sanctions result in higher costs, legal disputes, and operational disruptions for these businesses. Forced asset sales at steep discounts, combined with additional taxes, make it nearly impossible for foreign companies to operate or exit without significant losses. This also impacts global investments, as potential investors may hesitate to enter Russia, leading to decreased foreign direct investment. Key industries, including energy, are likely to feel the ripple effects.